The U.S. Federal Reserve has signaled on a plan to boost its key rate later this year that will mark the first hike since 2006. This as the Fed officials have agreed to leave the rate at near zero for now. And how the latest decision could impact the Korean economy, we have our Kwon So.
The U.S. Federal Reserve has decided to keep its key interest rate steady again at near zero. But it did signal a possible rate hike, citing an improving economy that's on track to grow between 1.8% and 2% this year.
The committee continues to judge that the first increase in the federal funds rate will be appropriate when it is seen further improvement in the labor market and is reasonably confident that inflation will move back to its 2% objective over the medium term.
Fed Chairwoman Janet Yellen said no decision had been made about the exact timing of an increase, but analysts already have their expectations.
But I'd still put the probability of them going in September at 60% or higher.
In Korea, the news of Wednesday's freeze did not come as a big surprise, as it was similar to the country's market expectations. That's why local experts say it will have a limited impact on the financial sector in the short term, but that Korea will have to be prepared for the second half of the year.
As Korea has cut its key interest rate, we could say we are moving on a different economic cycle than the US. Now, Korea's central bank will have to decide whether to follow a rise in global rates.
The Korean government cautioned against the impact of higher U.S. interest rates, saying it could lead to some capital outflow, but that it would be a positive sign for local exporters. Kwon So, Arirang News.